Need custom beer labels fast? At InTouch Labels and Packaging, we deliver industry-leading 3-day turnaround on every order, regardless of quantity. We carry a wide assortment of die-cut templates in standard and custom shapes and sizes. With a combination of top-of-the-line machines and experienced operators, InTouch can pump out an astonishing quantity of custom labels quickly. Our competitive pricing means you get top quality labels without breaking the bank. Need help? Our top tier customer service is here to assist you every step of the way. So why wait? Get your custom labels with lightning fast 3-day turnaround and unbeatable service at InTouch Labels and Packaging, where your brand gets the attention it deserves.
Good afternoon, everyone. Welcome to CBP's virtual spring conference. Super stoked to be here. I'm TJ O'Neill. As you can tell by the session, I'm going to talk about everybody's favorite topic, and that's taxes. I'll preface this conversation real quick with saying massive thanks to our sponsors at InTouch Labels and Chris Farman, who's also a CPA, and his team over at Small Batch Standard. So thank you to those groups for helping put this on, and especially to Andrew and the rest of the CBP team to carrying all this content to you. So we'll get started real quick and give a real quick introduction on myself. And I apologize when the text popped up on this, I could see that it's a little bit hard to read, but I'll make sure to highlight the importances for you. So no slide needed for this one. So my name is TJ O'Neill. I sit in St. Louis, Missouri, home of beer, U.S. beer, if you will. I've been a CPA for 11, almost 12 years now, and I lead Wipfli's manufacturing practice, specifically in the beverage manufacturing side. So really, really excited again to be here with everybody and talk about this topic that obviously I'm super passionate about, but there's a lot of really, really good content in here and good tips that taxes is maybe for some people, it's, something that you think about one time a year, usually around now, March, April timeframe. But there's a lot of important tidbits that's going to come out of this presentation that I want everybody to be aware of. And I want to make this as conversational as possible. So please utilize the chat to send over any questions that you have, and I'll make sure to address those as we go through the presentation. So just a quick outline of the agenda. Really going to talk quickly about where we are currently in the federal tax world, on what's kind of led us there, and then a little bit of what maybe the future has in store for us. After we give a brief recap, we're going to talk about some of the low-hanging fruit for brewery owners and operators to potentially take advantage of. And when I say low-hanging fruit, it's really opportunities that present themselves that are either low cost or no cost, that could help with tax savings and cash flow. Then we'll touch on sales tax exemptions, a little bit on the research and experimentation tax credit, and then into kind of a newer or little less familiar topic on cost segregation and energy efficient improvement considerations. And then obviously, if we have time at the end, I'd love to handle any questions that the audience has. So real quick, where are we now in terms of current tax legislation? So right now in this world, we are still riding the pigtails or the coattails of the Tax Cuts and Jobs Act of 2017, or TCJA. You'll see it abbreviated a lot of times. This was the most significant overhaul of the U.S. tax code since 1986. And I would probably bet that the majority of us that are on this presentation either weren't born by 1986 or definitely hadn't had our first beer by 1986. So very, very significant that it really kind of took over in terms of being the most impactful and significant change to the U.S. tax code. A couple of highlights that the TCJA had enacted. The first main one was that the U.S. corporate tax rate dropped from about 35% down to a flat tax rate of 21%. And for individuals, that tax rate now sits around 37%, or The highest tax rate is 29.6% with QBI, and QBI stands for Qualified Business Income. A little background on that. And so when Congress was mulling over this act, and they dropped this C corporation rate, and some breweries might be organized as C corporations. There might be a few of you on that have C corporation breweries. Big advantage of that is there's a tax code section called Section 1202 that potentially would reduce any taxable gain potentially down to zero upon the sale of brewery operations, depending on the facts and circumstances. And so we've got a lot of clients that are C corporations, and we're set up that way in effect to try and benefit from that tax code section upon the sale or an exit of a brewery operation. When they were mulling over this C corporation tax cut, some breweries are S corporations and partnerships, and that's how they're structured. LLCs, you'll see, and then they're taxed as S corporations or partnerships. And one of the things that was really off-putting was they cut the C corporation tax rate, and the individual partners or members of these S corporations or partnerships came to Congress and said, "Hey, you're cutting the corporate tax rate. You're not doing anything for the small business owners or the business owners of pass-through entities, which these S corporations and partnerships are." So they came up with a vehicle to reduce that individual tax rate effectively by this qualified business income provision. So that's benefited a lot of my brewery clients, especially that the ones that are S corporations and partnerships, because they're now getting on their taxable income or their qualified business income, they're potentially getting a 20% deduction or 20% haircut off that taxable income before they report it on their individual tax returns. One other thing that we had seen, particularly in this Tax Cuts and Jobs Act, was a little bit more availability to change our tax methods of accounting. So previously, that method of accounting changed specifically for going, to be considered a small business. It was $1 million, $5 million, and I believe it was $10 million. And they actually expanded that up to $25 million. And it's been indexed for inflation. So if a brewery has gross receipts now of less than 29, or I think it's 30 million for 2025, average gross receipts over the past trailing 3 years under that threshold, they're considered a small business. And so it opens up a new world of potential changes in accounting method. A few of those specifically that we see a lot of on the brewery side are switching from either the cash method of accounting to the accrual method of accounting, which is extremely beneficial depending on how our balance sheet looks in terms of the amount of accounts receivable and accounts payable we have, including prepaid expenses, some accrued expenses. So that's a huge planning opportunity, either switching to a cash or accrual method for tax purposes. But also it removed the requirement of Section 263A of the Internal Revenue Code, which is finally known as UNICAP in the tax professional space. What UNICAP required was for manufacturers, and I'll say this, we talk about craft breweries. In essence, craft breweries are a manufacturer, and I think we lose sight of that a lot. So there are, manufacturing specific breaks and tax cuts out there that, as breweries, we think, we're not really, we're not making widgets, right? We're making beer, we're brewing beer. A lot of states and federal government, they classify craft breweries as manufacturers. So that's definitely something to keep in the back of your mind whenever you're looking for ways to plan, especially around the income tax side. So one of the UNICAP, that 263A section that I had mentioned, manufacturers previously, if you were not considered a small business, you were required to take some of your overhead costs and actually capitalize that to your inventory cost, which then resulted in smaller deductions for those overhead or those administrative costs, which ultimately results in taxable income or reduced taxable loss. By switching or increasing the threshold of this small business taxpayer gross receipts level, the majority of breweries, craft breweries, independent craft breweries are not required to capitalize those costs any longer, which is great. We're able to deduct those overhead costs as incurred. Many of these provisions are going to expire, so we're in a very tumultuous situation right now. A lot of these are going to sunset at the end of 2025. And so Congress is really pushing to try and get tax legislation through in order to either retroactively or prospectively update the current tax code. One of the largest considerations specifically with this Tax Cuts and Jobs Act that's really affecting craft breweries along, again, with all manufacturers really, is this Section 174 change. So we'll touch a little bit on it in the rest of the presentation later on research and experimentation costs and research and development costs. This Section 174 carve-out, previously, any type of research costs or experimentation costs used to be deducted as incurred. So if I was paying labor, job supplies, contract labor related to the research and development of new product, processes, technologies, I used to be able to deduct that as it was incurred. This retroactively went back and said, as of 2022, December 31st, 2022, all of those costs, including some additional overhead and administrative costs, are going to be bundled up, and you're going to have to capitalize this and amortize it over a 5-year period or 15 years if it involves foreign contractors, which we don't see too often. But you'll have to capitalize this and add this back to income and take the deduction over 5 years, which is a huge detriment to our craft brewers and really puts them in a tight cash crunch if they have substantial research costs, because it's effectively phantom income. It's false income, and we're paying tax on income that we didn't receive. Just to kind of cover our base, we're going to talk a little bit about proposed legislation. So we've got this HR 25, the Fair Tax Act of 2025. Some of the stuff that they're throwing at the wall is kind of comical. Obviously, we don't have a crystal ball, so we'll see what sticks. But this particular act I find funny. It completely seeks to abolish the Internal Revenue Service and repeal federal income tax and payroll taxes. Bittersweet for me as a tax CPA. I don't know what I would be doing if they got rid of the Internal Revenue Service and federal income tax. I'd probably have to come work at one of the breweries, which I'm completely fine with if anybody has an opening as a controller or CFO. But I thought that was a little absurd. And it introduces a national sales tax to essentially replace these income taxes as a source of tax generation. Some other notable proposals: reduction of corporate tax rate from to 15% or 20%. I think that's specifically to American manufacturers. The elimination of the employee retention tax credit, which I think probably everybody that's tuning in is familiar with that. That's, if you can believe it or not, it's still out there. It's kind of going back and forth. I'm sure that there are breweries like some of mine that still have claims that are in processing with the Internal Revenue Service. So it seeks to eliminate that as a way to try and reconcile that budget. I think the proposed tax savings was about $70 million over a 10-year period, or $70 billion over a 10-year period. And then it removes the amortization of the R&D costs, which we touched real briefly on in that past slide, and it restores the immediate expensing of those research and development costs, similarly to how it was treated prior to December 31st, 2022 tax year. So I want to talk real quick about some of the low-hanging fruit that's out there for breweries. And some of these to you might seem very obvious, and it might be something that you've done since day one. But I will tell you that every piece of information in this slide, I have had a client or a prospective client or a new client come to me, and in reviewing their returns, they potentially have missed one of these. So one of the things I want to talk about real quick is the Work Opportunity Tax Credit, or you'll see it abbreviated WOTC. So the WOTC was extended through December 31st, 2025. I'm not too terribly sure if that is in the proposed regulations to extend that past the end of this tax year. But what WOTC does is it offers a hiring incentive to employers, not just specifically in the craft brewery industry, but all employers, to hire what the IRS considers target groups or eligible groups. You can receive up to $9,600 in a federal tax credit for each eligible hire. It's a range of $2,400 to $9,600 per employee, mind you, based on what target group they fall in. The percentages of eligible wages too. That's how they calculate it. So it's a wage-based tax credit. They have to work at least 120 hours minimum throughout the year. The way that we see this most taken advantage of is in the onboarding process. I get a lot of questions on, how can we legally ask our employees if they are part of one of these target groups? And the thing that I see the most is, you'll outsource this to kind of a human resources related company. There are a lot of providers out in the space that do these WOTC studies. And really, the tactics that they use are to incentivize individuals to fill out the paperwork. So maybe it's a $15 Amazon gift card to fill out this specific paperwork. So that's how we see it kind of implemented the most. On the right-hand side here, I've got the eligible groups. Again, this is kind of a handful, but the ones that we see the most often are food stamp recipients, qualified long-term unemployment recipients, and unemployed veterans or disabled veterans. And I want to point something out real quick. On the food stamp recipients, there's kind of a little caveat in here. The employee themselves does not have to be the food stamp recipient. If they live in a household, say they live with their parents or their grandparents or another family member that is on food stamps or is a SNAP recipient, their wages would qualify for this WOTC credit. So that's something that's often overlooked. The employee themselves does not have to be a food stamp recipient, but if somebody living in their household is, they would qualify based on this target group. The next low-hanging fruit is the FICA tip credit. Again, very, very common. This tip credit, again, is a wage-based credit, and it's available to individuals or businesses that are in the hospitality industry, mainly, is where we see it. The tax credit is equal to the employer's portion of the payroll taxes that are paid in excess of what is required by tipped employees. And so the federal minimum wage for tipped employees is about $5.15 an hour, which is significantly lower than the national federal wage for non-tipped employees. And what happens in these circumstances is when you go to run your payroll, we're calculating their base wage at the $5.15 an hour or whatever that they're paid. And then you have to break out the tips that they're receiving and hopefully reporting in full, and add that on an hourly basis back to their wage. If the tips on an hourly basis and the base pay, the hourly base pay, are in excess of what the federal minimum wage is, then you're overpaying your payroll taxes. And so almost every payroll processor has the functionality to prepare this report. I imagine it's probably low cost or no cost for them to do it. It's very easy. They're already tracking tips and remitting payroll taxes on this. They should be able to give you a report of the excess tips that qualify for this credit. One thing that I wanted to talk about very quickly, and it's extremely important, there are Department of Labor considerations, and this isn't necessarily a tax item. It's more of a legal item. But there are Department of Labor considerations around tips that need to be very, very front of mind when we're talking specifically around tip pools or shared tips. If there are managers that we have in our tap room that are, their primary responsibility is management activities, they are not able legally to share tips. They are not legally able to take tips from employees, to participate in tip pools. That is a big, big, big no-no. That said, if there are managers that have tipped employee responsibilities, so maybe they're working at the bar, or they're working the tables or the patio, and they receive tips directly from a customer as opposed to a tip pool, they are allowed to take those direct tips, but they cannot participate in these tip pools. It's a huge Department of Labor violation. They focus on, the term down here is customarily tipped employees. So kind of the same deal with the kitchen. Our kitchen workers, if we have kitchen workers, they're not customarily tipped employees. For purposes of the FICA tip tax credit, they are not, their tips are not eligible for this credit because they are not customarily tipped. Pass-through entity tax is another one that's popped up within the last few years. Back in 2017 with that Tax Cuts and Jobs Act, previously as individual taxpayers, we used to be able to potentially itemize certain deductions. So think mortgage interest, charitable contributions. The big ones were real estate taxes, personal property taxes, and state income tax. That Tax Cuts and Jobs Act, what it did was it limited or put a cap on the deductibility of state and local income taxes. So where we used to be able to deduct our real estate tax and our personal property tax and the tax on a vacation home and our state income tax, it's maxed out at $10,000. Anything you pay in excess of that $10,000, you receive no federal benefit for. So what the states did, and I don't remember which the first state was that did it, but they did a good job and they started a trend. They essentially put together a workaround that said, well, rather than these businesses, specifically partnerships and S corporations and LLCs, tax as sole proprietorships, rather than them paying these taxes on their state income on their individual returns, let's create a vehicle or a mechanism where they can pay the state directly from the business and work around that $10,000 state and local tax cap. And so, in Missouri, for instance, where I sit, we have a pass-through entity tax. And that allows businesses to, when they file their tax return, the brewery files their tax return, federal and state, if they have a tax liability at the state level, the brewery can pay that tax on behalf of the owners or the investors or the partners or whatever the setup may be, and get a federal deduction for that amount paid. And the individuals or the partners, they get a dollar for dollar tax credit on their state income taxes returned because the tax was paid on their behalf by the brewery or by the business. So it was a really clever workaround to the state and local tax cap at $10,000. And almost, I think about 60% of the states, if not more right now, have some type of pass-through entity tax that they've enacted in order to get around that cap. And obviously what this does is, it's a better net result for the owner, for the owners of the entity, because they're not being limited to that $10,000 if they have real estate tax or personal property tax. So we see this very often. It's a massive benefit in some of these high real estate and property tax states like a California or a New York or a Connecticut. So extremely beneficial, 100% legal, blessed by the IRS. Just a little workaround that the states put together. Real quick on sales tax exemption. So, we talked earlier in the presentation about how breweries are manufacturers. We don't make widgets, we make beer, we brew beer. There are sales tax exemption opportunities that vary by state that apply to breweries specifically. You won't see very often where they call out brewery operations by name, but what they do is they call out manufacturing. So again, I sit in Missouri. Missouri breweries are exempt on sales tax specific to utilities. So electric, water, sewer, gas, because they are considered manufacturing and they are involved in the direct use or direct manufacturing of a finished product. So the utilities sales tax exemption is something that quite a few states have, either full exemptions or partial exemptions on utilities that are used in direct manufacturing activities. And if you're not familiar with whether or not your state has a full or partial exemption, I can get some information out to Andrew at CBP that kind of runs down the chart of states. But it's a really good resource to have. So, ask yourself, the individual that's filing my sales tax returns, do they know this? Do they know what is sales tax exempt and what's not sales tax exempt? And it kind of goes past just the utility piece too. There are specific rules on the sale of gift cards, depending on state by state. Is it taxable when the gift card is redeemed, or is it taxable when the gift card is sold to the patron? So sales tax is a big piece, and obviously, it's assessed at the state level, so it's going to vary. It's like working with 50 different governing bodies, and you might get 50 different answers. But it's very important to know in your particular state and even in your particular municipality what is exempt and what is not exempt. Research and experimentation costs. So this is a very important one for our breweries, and it's something that we see missed quite a bit. And there are considerations that we have to factor in to alleviate this. But again, a quick background: these R&D credits are federal income tax credits, and some states have state level tax credits. Again, Missouri has a state level tax credit, California state level tax credit, quite a few others. The federal credit, the benefit is roughly 7% of a credit of what the qualified spend is. And so when I'm on calls with my current breweries or prospective brewery clients, when we kind of kick around the cost benefit on these studies, that's the kind of the earmark or what I would say the benchmark is about 7% of what the qualified spend on R&D is. Again, 35 states have a state level R&D tax credit program. That number bounces back and forth. I know Nebraska, for instance, they had a state level R&D tax credit up until 2024. There are new states that are implementing them now for the 2024 tax year. So those kind of bounce back and forth, but it's kind of roughly at that 30 or 35 state level. The qualified spend on that first bullet, think wages, supplies, and contract labor. Our supplies are just that. It's exactly what we need to make our beer. Equipment, I will say though, equipment itself does not qualify in terms of qualified spend. So if we're procuring new tanks or canning lines or anything of that nature, those fixed assets don't qualify when we're talking about quantifying the amount of the spend that went into the R&D activities. So wages, again, self-explanatory, the wages that we're using or that we're spending on our employees, but also contract wages as well. The federal credit itself, whatever it's calculated to end up being, it's a dollar for dollar reduction of tax due. Credit is a little bit different than a deduction. A deduction is, I save $1, I deduct $1, and then if I'm at a 30% tax rate, I save 30 cents. A credit itself is a dollar for dollar deduction. If I, at the end of the R&D study, have a $10,000 federal credit, that $10,000 is going to offset $10,000 of federal income tax dollar for dollar. Any tax that it doesn't offset, the credit carries forward, the excess credit of the tax liability carries forward for 20 years. So we've got a lot of clients that have these credit carry forward considerations, which is nice to kind of have that in our back pocket for planning purposes. Examples of common activities specifically that breweries are engaged with that might qualify for R&D. And this is obviously not an all-encompassing list, but these are the ones that we run into the most. So developing new product flavors or enhancements, developing, improving ingredient processing techniques, filtration methods, prototype batches, depending on what you do with the prototype batches once they're have come to fruition. Improving current and new formulations, adding new equipment for process improvement. Again, not the cost of the equipment itself, but some of the ancillary pieces behind that. Testing new or improved product designs to ensure consistency, testing shelf life and improved product designs, testing of product ingredient mixtures for flavor or aroma. Any of these activities that have a level of uncertainty behind them could potentially qualify for this credit. So to kind of dig a little bit deeper into the qualifications themselves, it has to be a new or improved business component. And a business component includes a product, a process, technique, formula, or invention, or computer software. We don't see that too often in the brewery space, but computer software definitely qualifies if you're internally developing this. It has to be technological in nature, so no soft skills. There has to be an uncertainty, back to my earlier comment, and there has to be a process of experimentation, whether it's formal or informal. The evaluation of alternatives, there has to be systematic trial and error to know when the testing is either successful or unsuccessful. So here's some R&D buzzwords just to kind of think about when you're talking this through later. So new products, new improved process, automation, prototype, trial and error, uncertainty, experimentation, contract brewing, cost reduction. These are the R&D buzzwords that when we're meeting with new breweries or current breweries and we ask them, what are they doing new for the tax year? These are the things that we hang on to and say, okay, let's take a look under the hood and see what qualifies. And, depending on the level of R&D, sometimes the juice isn't worth the squeeze. To get a $10,000 credit, and it's going to cost potentially $12,000 to do the study. Maybe it's not in the cards, but at least you have the option. One new item, and kind of save this for last because it's the one that we're getting the most traffic on as of recent, is cost segregation studies and energy efficient improvements. A cost segregation study is an engineering-based study that analyzes the costs of a new building or an existing building or a build-out, either acquiring, constructing, or renovating. It can be performed on new and existing buildings in order to accelerate depreciation, increase current tax deductions as a result of that accelerated depreciation, defer future income tax, and increase our tax flow as a result of the cash flow, or increase our cash flow as a result of the tax savings. The nice thing about the cost segregation study is we can actually look retroactively at buildings that were placed in service and do this engineering-based study using the rules and laws that were in place in the tax year that particular building was placed in service, which is really nice, especially from tax years 2017 to 2022, where there was accelerated depreciation or bonus depreciation of 100%. What this cost segregation study does, before I jump to the next slide, and we'll kind of illustrate it in these next slides, for tax purposes, a commercial building, so we've got our brewery, commercial building, for tax purposes, it's depreciated over a 39-year useful life, so almost 40 years. If I have a $4 million building, that's, how much is that? $100,000 of depreciation annually. By doing this cost segregation study, I had to think about the math. We're in the middle of tax season, so I'm surprised I didn't have to break my calculator out. By doing this cost segregation study, the engineering team essentially looks at the entire makeup of this commercial building and breaks it down into different units of property that would qualify for shorter class lives. So rather than taking that same property over a 39-year depreciable life, there are pieces of that property. So the 39-year piece would, be the building envelope, the shell of the building. But internally, there are pieces of that property that would qualify for, call it 5, 7, or even 15-year tax lives. And what's important about those shorter tax lives is that anything 15 years or lower qualifies for accelerated bonus depreciation. And so you're parceling those out into separate shorter class lives in order to accelerate the depreciation that otherwise you would recoup over almost 40-year period. So a quick example, this is just for numbers' sake. We have a building that we placed in service in August of 2022. Looks like it was a small build out of about $300,000. With no cost segregation, that piece, $300,000, is depreciated over 39 years. With the cost segregation, and these are hypothetical numbers, but pretty close to what we see in the industry standard, we're breaking out and reallocating this cost, $30,000 of it to 5-year property, so almost 10%, $100,000 to 15-year property, and $168,000 back to that 39-year property. The overall result of that, since we have accelerated depreciation in our back pocket because we're in the 2022 tax year, that $30,000 and the $101,000 of 5 and 15-year property, we can deduct the cost of that on day one. So we actually pick up about $130,000 accelerated deduction on a $300,000 property that's placed in service. So almost a little bit shy of a 50% ROI specifically on this cost segregation. And these ROIs almost always, depending on the circumstances, pay for themselves in spades. It pays for the study itself in terms of cash flow and tax savings. The nice thing about the cost segregation, again, we can go retroactively, but we don't have to go back and amend tax returns, which is really good for businesses that have multiple owners. Because if you amend the prior year tax returns and we're a flow-through entity, like a partnership or an S corporation, those individual owners or those owners that are, whatever their structure might be, they then have to go back and amend their tax returns. So there's a lot of changing around that needs to happen. Mechanically, we can file a method of accounting change, like I touched on really early in this presentation, to essentially catch up this deduction in 1 year without having to go back and amend any tax returns, which is always preferred, just to save the cost and the headache of having to go back and amend prior period returns to get this potential deduction. Similar to the cost segregation study, 179D, which is an Internal Revenue Code section, has a specific energy efficient enhanced tax deduction for commercial buildings. This is a little bit newer. This the deduction itself is not new, but the enhancement of the deduction is new with the Inflation Reduction Act. And what this 179D study does is it enables the building owners or the tenants to claim enhanced tax deductions for installing qualifying systems in buildings. So when we think systems, interior lighting. So think, your LED lighting, energy efficient, HVAC, hot water systems, anything with the building envelope like windows or roofing or anything that is going to improve the energy efficiency of the shell itself would qualify for this enhanced deduction. And there's obviously a really big push in the space right now around energy efficiency and sustainability. So we're seeing a lot of this in the space, especially as new breweries are being built or current breweries are being expanded, or we're just refreshing a little bit to try and be a little bit more conscientious about our energy spend and reduce our footprint. So projects placed in service after January 1st of 2023 specifically qualify for the enhanced portion of this deduction. One caveat, though, in order to qualify for the true full maximum benefit, you have to pay what's called a prevailing wage, and apprenticeship percentage hours must be met. So we can't just pay our cousins or our buddies to come over and install an HVAC for cash on the side. We have to meet the prevailing wage requirements as dictated by the locality that our brewery is in. Again, with that enhanced deduction piece effective in 2023, our maximum deduction specifically on this code section went from about $1.88 a square foot to $5 a square foot, so more than doubled the enhanced deduction, again, because this was a really big push on the last administration that got this piece of legislation approved and in law. So they're really trying to enhance our energy efficiency as a country here. The same building, it's worth noting, the same building can recertify if energy improvements are made every 3 years. So if you're continually increasing your energy efficiency with installation or replacement of these systems, you can revisit this every 3 years. That's all the time that we have. I'm coming up right on 45 minutes. I appreciate everybody's attention. Hopefully you learned something. I'll get these slides out to everybody. I know they're kind of difficult to read, but again, special thanks to our sponsors. Huge thanks to Andrew and CBP, everybody over there for bringing this awesome conference to everybody. A ton of great content in all facets of the brewery industry. So I'm hoping everybody can jump on some more of the sessions today. Hopefully you learned a ton from this session and some of the sessions yesterday. And if you need anything from me, I'm happy to have any conversations around our content here, or even if you want to just invite me out for a beer next time I'm in your neighborhood, I'd love to do that as well. So I appreciate everybody's time and attention, and hopefully see you at the next CBP event soon, or CBC in Indy in about a month or so. Take care, everyone.